Andre, let's start with you. I don't know where David is, but you're looking at some of the geopolitical issues going on right now because in the United States, the Federal Reserve is looking at further changes to its interest rate policy. What is going on? Break that down for us in common language.
The global landscape has changed in recent years. Geopolitically, we've moved from just words to actual military confrontation. I mentioned that the Russia-Ukraine situation, most persons would not have bet on the situation escalating to the level that it actually is now, and that really hasn't shown any signs of letting up. We have added to the pile, the Israel-Palestine situation, which if you've heard from Prime Minister Netanyahu, he's upped the ante and saying a lot of strong words that whatever your personal perspective is, it's I don't necessarily want to get into all of that, but we still also have the China-Taiwan situation that, I mean, it has kind of taken a back seat to all of what I've mentioned earlier, but it is still there, and it's something that we should be monitoring, right? Now, I started off on a somewhat negative tone, but uncertainties have always existed. Volatility has always been constant, despite bouts of stability. And the truth is that sometimes volatility presents some of the biggest opportunities. The issue, however, is always getting it right. Now, that's what most persons struggle with, right? Your best trader will tell you that you won't always get it right. The issue is trying to get it right more than you actually get it wrong. Now, if you look at the Russia-Ukraine situation, that meant higher costs for grains. The sanctions also ensured that there were higher oil prices. We have a similar situation with Israel and Palestine. Pretty much, it threatens too that if other Middle Eastern countries and somewhat the West too getting involved, it may mean that oil price could actually head in towards the upside even further than it already is right now. Now, central banks in the last at least year have been on tightening policies. That started from the inflation. The inflation issue really came out of the supply constraints that was from COVID, right? We've seen north of 500 basis points in terms of increase from the Fed. Other central banks are probably a little bit lower, but we have at least 550 basis points on the Fed side. So far, that hasn't quite yielded all of the success that was anticipated, but it actually supports the recent argument from a lot of analysts that it is likely that interest rates will remain higher for longer. We've heard that throwing around somewhat. If you really think about higher for longer, in to be fair, interest rates started from near zero. So once you get into 3, 4, 5, that's still high, right? And until we start to see inflation start to adjust towards the targeted levels, it's likely that they will be keeping policy somewhat restrictive. Bank of Canada, they actually held interest rates last week, so did the ECB. And tomorrow and Thursday, the Fed and Bank of England is supposed to also make their announcement. We've seen slowdown. China has shown signs of slowing. Germany too. Inflation in Germany, I think, is now at a two-year low. Other Euro area countries are actually showing signs too. Now, if you look at on the consumer side, because of the adjustments that we've seen so far, it's likely that some persons will start to decide how much they can borrow if they really do need to. Because if you look at even the housing market in the US, I think last week rates were up as high as 8%. I don't think we've seen those levels in quite some time. The banks have actually been forced to pass on the higher costs to their consumers.
They reach Jamaica levels. US
Right.
and Jamaica running competition for interest rates now. It used to be way lower there
Well,
than
there you
here.
go. But once you start to have the benchmark adjusting, the banks will have to pass on, because what you have to do is you have to adjust on the borrowing side. If you adjust on the borrowing side, you also have to adjust on the lending side, right? Because banks really make money from spreads, right? Whether it be buying and selling or borrowing and lending, right? Now, one of the issue that came up maybe a couple of months ago is whether or not we're going to end up with a recession in the US. Now, I don't think the smartest guy in the room is going to take on that conversation right now, because it sounds as if almost that you're preaching doom and gloom, right?
But that conversation has been happening since COVID.
Well, to be
Continually.
fair, we've had 3, 4, 500 basis points, and the market still is operating as if it's somewhat normal, right? Now, to be fair, on the stock side, you'll find that people will gradually move away from that, because it's considered a little bit more riskier than investing in. You can talk about U.S. Treasury bonds right now, which you can find north of 5% on U.S. Treasury bonds, right? So to be prudent, you have to stay invested. I don't think anybody's going to take a platform and say, take your money, put it under your mattress. I think we're kind of gone past those days now, right? It's you really need to stay invested. Most importantly, however, you have to consider the type of risk that suits your portfolio. So if you're the less risky type of portfolio, you really want to stay on the shorter end of the curve and look for assets that have better quality. If you have more risk that tolerance, then of course what you can do is look for longer dated assets that are deeper risk weighted discounts.
So,
Those
Andre, I wonder, did you hear? So, you mentioned about the housing market and the interest rates being high. I don't know if you heard this bit of news that came out, I think, late last week, that there was an announcement from the Biden administration of this proposal that they put forward for, what was it, down payment assistance to help first-time home buyers buy a house. They would be helping you to pay your down payment. Did you hear that bit of news?
I can't say that I've seen that directly,
Okay, it's
but
very,
I
very
mean it's
interesting
great.
development. Because interest rates are so high, the administration says they want to help first-time home buyers whose parents didn't own a home either. They
Right.
want to help you by giving you some money to make the down payment, because that is one of the biggest hurdles to home ownership, coming up with that 10% or 20% down payment, that
Right.
deposit.
So remember too, that the policies of the Fed really is restrictive, right? And the consumer will feel it. I think one of the things that they're looking into as well is that for student loan borrowers. So back in from the Trump era, there were some concessions regarding student loan. I believe now, I think it probably starts somewhere about November. So that's additional money that's gonna have to come out of the hands of the average individual. We've seen where a lot of companies have already been laying off as well. And again, it comes back from the restrictive policies from the central banks. Because you see, it's not heavily talked about, but even on the domestic side, we've seen where there are cuts being made, but it's not well publicized.
Kish says interest rates are in the single digits. Years ago, it was double digits. Mortgage rates was at 14% in 2005. Why are people complaining about 7 or 8%? I remember around 2010, Audley Shaw clamoring for single digit interest rates. That was the thing. His mission was to bring interest rates down to single digits, because 15%, Kish, it was even higher than that at one point. All 20% mortgage rates, interest rates were really ridiculous. But we've gotten used to the single
Exactly.
digit rates
Right.
now,
So
right,
somebody
Andre?
who owned a home from probably like 15, 20 years ago, or longer than that, will tell you that Would have gone to NHT and gotten 5% interest rates, they were like, what? Because they know of double digits. But we've gotten accustomed to those relatively low interest rates for some time now. So it's a little bit difficult for us to adjust to it. But if policies remain the same over time, you'll find that the landscape may also have to adjust to that as well.
All right,
One
let's bring David in. You wanted to comment before we move to your topic, David?
Sure. So one thing people need to also contextualize is other part of the equation is the cost of property has considerably gone up, today versus, early 2000s. So while rates might have been relatively quite high back in those days, in the same context, the monthly cost on that same property might not have been as high. So there is some nuance to the discussion, because if I'm looking at a $3 million property back in, let's say, 2005 or 8, it's probably 14%, the monthly payment on that is likely to be much lower, even over a longer tenure, probably 30 years.
But that's also relative too, David, because at that time the exchange rate was a lot lower. Same way, so 2010 exchange rate was about 70 to 1.
2013 was
70 and 80 to 1,
to 1.
and now it's 150 to 1. So all of that is relative. Even though the payments were lower, the currency was also worth more.
No, but that's just the point, Kalila. So when Kish was asking, why persons are complaining about rates being higher while some of them are still single digits, the context matters, because as we're highlighting, the cost that you have paid perpetually over these last probably 20 years in a sense versus paying today is drastically different. Because for one, the down payment is going to be a lot different. And in the same breath, the reality is those monthly payments can increase, as some persons have come to realize now, because persons were steadily paying, for example, let us say 60 grand, every month, and all of a sudden your bank increased the mortgage rates recently and you're paying extra 20 grand per month. So even though interest are probably single digits in context, an increase in rates does have an impact on your pocket, because that's less money you can spend on other productive means.
Right.
For example, investing, for example, upskilling. Like the impact of higher rates might not show up for, a person who's going to a bank and borrow a loan, but there are different ways that it will show up through the parts of the economy, because when one person doesn't spend, that's one person who didn't earn an income. So that's how I look at it. The less spending there is, less income that's going across the entire board.
Natisha says, I would take 7 to 8% now, but rates are nowhere near that. Call the banks tomorrow and you will be shocked. It's like 9, 10% now.
Call Scotia.
Right. So it comes back to the point that I made earlier, that banks, financial institutions are in the business of borrowing, lending on spreads, right? So what you see is usually a band. I cannot speak to exactly what those numbers are, but usually you have a base where the financial institutions are willing to borrow or buy, and another where they're willing to sell or lend, right? That's how they make business. That's how, when we have these AGMs, you guys go there and you ask the questions, why is it that the profit is down? It's because margins would have shrunk somewhat. Now, to go back to the original point, it's a little too soon to say that we are in a new paradigm, a new shift in terms of where rates are likely to be, because once you start to see inflation numbers adjust into to the direction of where central banks want them to be, there's a good chance that we may see some sort of easing coming into play. But as it stands now, this is the reality of what we're dealing with, and it's all that we can pretty much talk about.